Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy any investment based solely on a tip or recommendation. Please do your own research.
Hello and welcome to the Sunday Roast. It's Sunday the 11th of September and a rather sombre affair, as we all pay respects to Her Majesty. This show is obviously recorded ahead of the day, and the news has just broke of the passing of Queen Elizabeth II. She was a constant in our life and saw 15 prime ministers. That's some service, Kev. What are your thoughts on it?
Yeah, I mean, rest in peace, Your Royal Highness. It's a very sad day, but 70 years of service is quite credible to the country. I mean, I'm 54. She was constant in my life as Queen. I enjoyed listening to her every Christmas and what she had to say about life. She was a very wise woman, I think. And you can't even contemplate the social change over the last 70 years that she's experienced. It's absolutely...
I think it's how dedicated to the cause she was, isn't it? That she said, didn't she, from the get-go, she was going to be the ultimate public servant. And she did exactly that, even to the point, she said she signed a lot of her recent releases were signed The Servant. And she was exactly that. She did it right through, even to the point where I believe she met Liz Truss this week and obviously asked her to form a new government or a new cabinet. And that is, 48 hours prior to her death, she's seeing out the Boris Johnson and seeing in the new prime minister. I think that's some dedication. Wouldn't you agree?
Absolutely. No, it's very sad, but at the same time, I think we have to celebrate her life because, she's been an incredible servant and an incredible monarch to our country.
So I guess the other thing is segueing into our guest this week. We've seen the announcement of Liz Truss this week that she's put in a cap on the energy bills of £2,500, which is a big relief to a lot of households, or nearly probably every household, you could argue, in the country. If you look at the historic prices or what could have come in from October, where they were talking about 3,200 and then up to 5,000 in January. This is capped now for 2 years, and it's a significant. It's going to be, households are going to realise a significant saving. So I think that's a big relief for Brian. Breathing a big sigh of relief for a lot of households. And we've got an inherent problem with energy, haven't we? The gas in the whole grid is under a lot of strain. Energy prices are going up. Do you know anyone who we can talk to about energy reserves or power reserves?
Yeah, I think I know a few South African boys who know a little bit about energy reserves.
Who might that be?
I don't know, but they're here, so you might as well ask them.
Welcome, Mast Energy Developments, Pieter Krugel and Louis Coetzee. Welcome, gentlemen.
Hi, Phil. Good and busy, thank you. I hope the same on your side.
Absolutely, it's non-stop. So obviously we saw the announcement in July that you'd moved from the CFO to the CEO, so congratulations on that. And do you want to tell the listeners more about what it is that Mast does?
Good, thank you for that, Phil. Yes, Mast Energy Developments PLC is a London Stock Exchange listed company. We are positioned in the flexible or the reserve power market sector in the UK, and basically what that means is we fulfill a very, very niche, and at this stage, also considering the energy crunch globally, but specifically in the UK, we fulfill a very important role in the energy mix in the UK. So the main role of flexible power in the energy mix is to step up when renewables don't perform. So when the wind doesn't blow or the sun doesn't shine, then obviously, because the energy mix in the UK is largely renewables at this stage, dips and there could be a collapse of the national grid, and that's where flexible power then comes in to stabilize the grid and to add to the required generation of the grid. So it's got a very, very important and at this stage critical role in the UK energy mix. So we slot in there. It's a rapidly growing part of the UK energy sector. We're expecting it to reach 4 terabytes in the next 5 years, and currently it's around 1 terabyte. So there's massive growth potential there from a demand perspective. So that's what Mast does. It does it by way of acquiring, developing, and operating flexible power sites, which are typically between 5 and 20 megawatts per site. So that's the way that we do it. Our sites at the moment is gas powered. So we follow a low emissions gas power generation setup, which fits again quite well into the energy mix. So it's seen as an enabler of renewables. So although it's not directly and purely seen as renewables, it's an enabler of renewables. It's part of the chain. So that's the way that we do it. And we decided to do the IPO last year to give the company some reach into the market and to raise some capital. Previously, Mast was part of the Kibo group, and that started in 2018. Kibo ventured into this market with a majority interest in the then Mast, and then spent quite a bit of time and effort to build the business case and the processes. So we got that foundation very nicely laid out, and then last year we did that IPO, and we've been running from there.
So just for listeners, so this is literally, as you mentioned, it's what's known as gas peaking, where high pressure gas is burnt in a large engine, in a reciprocating engine, and then that generates the electricity. At Piebridge in particular, I think it's a 9 megawatt site, so that's how much the power that delivers, and that's the one that's that's in steady state operational right now, isn't it? The Piebridge. Do you want to tell the listeners the aims or the targets for the other sites and bringing those online as well at Bordersley and Rochdale?
Yes, yeah. So maybe just having a look at where Mast is at the moment. So we own three projects, of which Piebridge, as you mentioned, is our first fully operational site. So that's our flagship site at this stage. We acquired that as an existing site, so we did not have to construct or develop that site. We took it over as an existing site, and our opportunity there was to optimize and enhance the site to get as much economic benefit out of that as possible, and that's what we've been doing in the past few months. And as per all our announcements, that's all been done, and we are seeing some very good numbers coming out of Piebridge now. In fact, in excess of expectations, and we can maybe delve into a bit of those details later in the conversation. But that's Piebridge, so that's 9 megawatts. Then we've got Bordersley, secondly, which is our second most advanced project at this stage. It's already in construction, so that started. We have encountered a few challenges, most notably, and as disclosed and announced in our latest interim results, that we've got that we're just relooking at the EPC configuration there. So obviously the runaway inflation situation globally, but specifically in the UK, does have an effect on capital costs. And our challenge and opportunity there is to see, what can we do to bring that back down. And we've got various ways to do that. So we're just sorting that out, and that's essentially been done. And then the only other thing is the gas connection route. So Bordersley is situated in a very densely populated area in Birmingham Central. And the gas connection route runs parallel and under a canal. So we had to get an easement from the Canals and Rivers Trust there, which has also essentially been done. And once that's sorted, we'll proceed post haste with the construction of the site. So that's Bordersley, that's 5 megawatts. And then onto our third and final site at this stage, Rochdale, 4.4 megawatts. Development phase at this stage. We acquired that as a shovel-ready site a while ago. Busy with the development. In the development process, we took a decision to look at Rochdale as a battery site, as an option for a battery site, because we are keen to diversify the generation mix in our portfolio, and we do believe that batteries has got a very bright future, and it's definitely something we'll do. And we thought, if we could do it in Rochdale, why not? But interestingly, that came back. Rochdale is also situated in quite a densely populated area, and there was the import-export electricity connection in order to export the electricity from the batteries were not readily available at this time. So we decided, okay, we've done the feasibility work at least, so that's good. We've got that on the table and we can apply that to a next site, but we're going to revert Rochdale back to the gas peaker development phase or process, which we've done. And Rochdale is back on track to be developed as a gas peaker. So that's our current 3 sites, which brings the portfolio to circa 20 megawatts. Our aim looking forward with regards to the portfolio is to get that up to 300 megawatts. That's been the stated target since the beginning. And that was kind of the fundamental basis of the IPO as well. So that's our longer term target. We'd like to get to 50 megawatts this year, still double that next year, and then get to 300 megawatts, which we're busy with. One of the main activities at this stage is to assess and review possible sites, which we're continually busy with to make sure that we select the correct sites that adhere to all our investment criteria and tick all the boxes. And we are, in fact, very far advanced with some of those sites with regards to negotiations and even legals. So we expect to grow the portfolio very imminently.
The scenario with each one of the sites, the baseline amount is going to be about 20 megawatts, but where is the opportunity to grow even the 3 sites that you have? Because I remember seeing some stuff back about a year ago, or maybe less, about each one of them has the potential to have more than this on site.
Yes, that's a good question, Kevin. So I think, so on the one hand, each site is governed largely by its planning consent. So the planning consent kind of dictates the amount of generation that you can output, and you can always apply for more if the necessary criteria are there. And then also the connections, the gas and the electricity connections is the other criteria in order for generation output. So typically most sites are kind of what they are. So Pyebridge and Rochdale, for example, just from a connections perspective, they are pretty much capped at where they are at the moment. The only way that we can enhance or increase the generation output from those sites is from running hours, and that's something that we're looking at and that we've actually done on Pyebridge. So on Pyebridge, for example, we've actually more than doubled the allowable running hours from 1,800 hours per year to 4,000. So that creates quite a nice lift for potential generation, and obviously revenue generation then. But Bordersley has got quite a nice capacity headroom, and we can take that up to, if I recall, up to 10 megawatts. So that's also something that we will have a look at. But regardless if it's connection availability or running hours, our end goal is to get each site as efficient as possible.
So tell us a bit about or what you can tell us about the numbers in Pyebridge. How has that, or what has it produced since steady state has occurred?
Based on all our optimization work that we've been doing, basically on 2 fronts. So from a technical perspective, so to get the engine technically as efficient as possible. And I'm not going to bore anyone with the details of that. It's very technical, but I mean that's all been done. And then also from a commercial perspective, so the power purchase offtake agreement with our offtaker Statkraft, to refine and enhance that. And what we've been seeing out of that is that not only has Pyebridge started to generate our expected returns, it's actually far exceeded that now. And I think to a large extent that's also owing to where the energy market is at the moment. As we've been saying the past while, the energy prices that we're achieving in Pyebridge at the moment is around 5 times higher than the energy price at the time of the IPO. And we are definitely seeing the benefit of that coming through.
Yeah, and your share price is 5 times lower. So how do you work that one out?
Yeah, that's a very interesting one. But we hope that that gap will close now. From the numbers that's going to start coming through. So just to put it in simple terms with regards to PiBridge, so our stated target operational profit for a site is typically £5,000 per megawatt per month. And I mean, that's we specifically designed a metric that is very easily understandable and that can very easily be applied to a larger portfolio. So if you talk 5 megawatts or 10 megawatts or 100 or 300, it's very easy to multiply the 5,000 by the number of megawatts, by the number of months per year, and get a total operational profit expectation across the portfolio. And at the moment from PiBridge, we're seeing about 4 times that, or 400% of our target operational profit. So I mean, that just shows the potential, of earnings from this business.
Okay, so that's pretty dramatic then. So we're talking maybe 20 megawatts or 20,000 per megawatt is what you're saying. So £200,000 a month is really what you're looking at with 10 megawatts, which is £2.4 million a year, whether that's all profit, but certainly net cash flow at this moment in time. And you have a market cap of 4.8 million, and you've got 2 more sites. This is where we drop the microphone and say, what is everybody doing? Because it doesn't make any sense.
Yes, absolutely.
We start talking about rugby, because you must have played rugby. You all guys can't see this guy, but he's a very big man. What position did you play in rugby, Peter?
Yeah, I come from playing rugby is not negotiable. It's compulsory. So yes, I did play rugby lock.
You're the lock forward, and you've still got your ears, so that's impressive. So well done.
Thank you.
It's very good. So tell us then, this is the present. So we have 3 sites. We have 20 megawatts. One is steady state. One is construction, and hopefully, I mean, what sort of time period do you think the construction one's going to be finished? I mean, even just a guesstimate. We're not going to hold you to it.
So the construction phase for a typical 5 megawatt site usually takes between 6 and 9 months, and a very large portion of that is owing to the engines themselves. So the engines are not constructed on site. The engines are constructed with the OEM, and our OEM sits in Germany, which is Jenbacher. So it's actually constructed there, and then it's shipped in a container over to the UK. So a very large portion of that construction period actually is owing to the construction of the engine and then shipping that, getting it onto site. And all the works on site is fairly ancillary. It's fairly, it's connecting up the engine container unit to the connections and the balance of plant, etc. So that's the bulk of the work and the time of the construction process. And what we've been seeing and what we expect to continue is just the global supply chain issues and the whole Brexit thing. So getting large imports into the UK does take time. We actually had to drive to Germany the other day because one of our parts was sitting at customs at the border and we just couldn't get it in. So we just drove to Germany ourselves to pick up a part and drove back. That's the hard reality at this stage. But I mean, we're working around that. We're finding solutions and we're trying to push down development times as fast as possible.
And how do you see demand continuing, Peter? Obviously, we've seen stresses on the grid. We've seen obviously the energy crisis that's happening around all over the world, not just in the UK. But do you still see that the demand being high for the foreseeable future for energy and basically reserve energy?
Yes, Phil. We've got a very, very positive outlook on energy demand, specifically in the UK. And as I alluded to earlier, the flexible power sector of the UK energy market, has seen and is seeing exponential growth, and we expect that to continue. As I explained, it's an integral part of the whole renewables setup. So as long as there's renewables and as long as batteries hasn't been able to pick up base load storage, which I think we're still quite a bit away from, and we'll get there eventually. And at that stage, Mast will be well positioned to participate in that part of the market as well. The flexible power market is going to have a critical role to play, and the demand side at this stage is light years ahead of the supply. We just can't keep up with the supply. Our off-takers told us, straightforward that they'll take anything that we can generate at this stage. The demand is just multiples from where the supply is at the moment.
So we're at the situation now where we have 20 megawatts in the frame, if you like. We're hoping to get to the 50 megawatts by the end of this year, and the 300 megawatts by the end of 3 years, I think was the stated aim. Whether that's possible with all of these supply chain issues and back, we don't know. But how do you intend to do that? Because that seems like a huge, a huge mission, if you like, in terms of the current situation.
Yes. Kevin, that's one of our main focus points at this stage. And I think to a very large extent, we've already laid the foundation for that. So I think economies of scale is a very key part of how we are going to do that. So we've got a model that's already been proven now with our 3 existing sites, and we're just going to copy and paste that on further sites. So when each new site comes in and we start further building out the portfolio, it's not going to be a case of reinventing the wheel with each site and going through all those pains again. Firstly, the blueprint's there. We're just going to apply it on the site. And then secondly, all the lessons learned from the previous sites, such as, from a operational perspective from Pyebridge, that's going to be applied on the sites. And from a development side of things, from Bordersley and Rochdale, that's also going to be applied. So I think from an economies of scale perspective and from a lessons learned perspective, that's all going to be applied. And it's not going to be a case of having to reinvent the wheel for each site that comes in. So we expect kind of a snowball effect, if you will.
So is there many of these sites available to purchase at the minute? There
are. I think due to the demand, as I said earlier, the supply can't keep up, and not only from a generation perspective, but also from a site development perspective. And I think that's one of our benefits. The hurdle to entry into this market is fairly high. It's not something that anybody can do. I think a lot of people think they can do this, but I think it's been proven that it's not as easy as it seems. So getting planning consent, getting the connection secured, the basics of the project development is a fairly attuned business. So I think that also adds to the supply side of available sites. But there are sites available. We've got very good relationships in that regard, which we've built up over years. With reputable market-leading developers of shovel-ready sites, as well as operators of existing sites that's looking to exit the sector, for whatever reason. So we've got those relationships cemented. That's taken a lot of time, and we see it as an investment, and that's part of our portfolio growing process.
So, do you envisage this year being able to increase the megawatts by actually having stuff that's online rather than just shovel-ready projects?
Yes, that is a very, very good point. So something that we've seen with Pyebridge versus Bordersley and Rochdale as an example. So where Bordersley and Rochdale are development sites, so they have to go through the development phase first, and then construction, and then operations. And that's got its benefit. It's kind of like buying a new car versus a used car. Both has got its own unique benefits. So from a new build perspective, obviously it's going to have more longevity and in the longer run be profitable. But it's going to take time to get there. But an existing site such as Pyebridge can start running almost from day one. And although like a used car, it's not going to be as such a long life cycle as a new build. It's going to start generating cash early. It's going to be more profitable earlier. And, based on our calculations, we've seen that we need to have a mix of the two. So we're definitely going to go for a balance between new build sites and existing operational sites with regards to further acquisitions.
So from the point of view of 50 megawatts, you have this in your sight. You feel that the next 30 megawatts is on its way, because here we are in September, and obviously December's not too far away. Are we going to be able to hit 50 megawatts by December 31st?
From a process perspective, that's in the pipeline. So I think the next 30 megawatts has already been identified, already been due diligenced, and we're on varying stages of negotiations and or legals on that. I think a key component to that is obviously the funding side of things. So these sites typically go for between, the range depends on the quality of the site and all of those things, but it typically goes for between 25 and 50,000 pounds per megawatt. So, I mean, if we do that calculation, just the acquisition cost of a shovel-ready site does come at a cost. So our opportunity is to figure out how best to fund the purchase of additional sites. And I think to a large extent, that's going to determine also the timeline to get to, the next targets.
And what are your options then to fund this?
I think predominantly we would like to get into a position as quickly as possible where our free cash flow from existing sites, such as Firebridge, gets to an extent where we can use a portion of that to fund further acquisitions. So it kind of starts becoming a self-feeding machine. So that's our main goal, and we want to get to that as quickly as possible. But in the interim, it's kind of a fine balance. So it's a calculation. You can do a calculation to see at which, how many megawatts do you need in production in order to get to that point for the machine to start feeding itself. But up until that point, we'll need to look at other sources. And I mean, at the end of the day, we're going to use the best possible option.
So do you see dilution coming down the line or not? Or is that at this level just not wise?
The share price level, I think, is always a very important consideration. And I think as far as practically possible, we'd keep that in mind. I think dilution in general is also something that, we'll always factor into the equation and the ultimate decision. So, it's not something that we would prefer. I think, just economic basics tell you that, equity financing is fairly expensive. So, that's why we would look at all options. And as I said, at the end of the day, we'll use the option that makes the most sense for everyone, but also, specifically for the shareholders as well.
In terms of the funding, I mean, the whole funding model for MED is not a simplistic one, as Peter has been trying to explain. It's a rather complicated one, and it's a multidimensional one. To single out dilution as only one factor would not be accurate. If ever there's a situation where dilution, which I would rather phrase as equity funding or placing, is in place, it would form part of a value proposition that makes sense to investors. So it's very important to see that it is one of the tools that's in the toolbox to utilize in terms of a comprehensive funding solution, and it must make economic and investor sense within that context.
Louis, what else would you like to add about Mast Energy Developments? Because after all, this is your baby that you gave birth to from Kibu. So what is the situation?
So first and foremost, my apologies for that rude interruption just now, but I just thought I wanted to add that little bit of perspective to a very complex question. But from our perspective, I think it's very important, if I can add one thing, that is that one should not lose sight of the progress that MED has made over the last year. It's got into a position where there's revenue generation. That revenue generation is exceeding expectations very, very significantly above what we expected. There's a pipeline that is in development, and MED has been dealing with a lot of unexpected and outside challenges, which it has been dealing with quite well as far as I'm concerned. And I think one of the things that one should look at is the recent increase in position by Kibo, where Kibo decided to increase its position in MED. And it would not have done that if they were not convinced of the business case and of what the company believes is going to come out of MED in the future. So it's a very significant move on the part of Kibo in terms of that increase in position. And I believe the company is on a very healthy foot at the moment. Going to see some exciting things come out of MED in months and weeks to come.
Yeah, I mean, that's the one thing that we haven't really talked about is the overall structure of Mast Energy Developments, because it is very, very tightly held effectively in terms of investments. Kibu holds what, 50-something% now, is it, Louis? What is the percentage?
61%.
61%. So 39% is free float, and that's not all free float either, because you have some major shareholders as well, I'm sure. And I hear what you're saying, Peter, by saying that hopefully you're going to buy some assets that are in production, which basically means we're going to add straight to the bottom line of income, and will allow you to get that snowball rolling, which I think once it does, is really going to be a great investment.
If I can just add one more thing, Kevin, and that is that it's a rather awkward situation in the sense that as all these external circumstances deteriorated, like the Ukraine war and others, the fundamentals of the business that MED is in has improved. Yeah, the business case is just getting better and better. So that's also a very important perspective to keep in mind.
On that note, Pieter Krugel and Louis Coetzee, thanks very much for your time.
Thank you so much, Paul. Thank you, Kevin.
What do you make of that? What do you make of the whole thing, Mast? I mean, we've seen a slight jump in the price. Obviously the last couple of sessions, I think it went up from 2p up to about 2.5, 2.45 marks. So there has been a nice rise, but it's still massively undervalued, right? Looking at even just that one site pie bridge, it's that's worth the market cap alone
and more. I mean, basically, you're saying using £200,000 free cash flow per month. That's £2.4 million a year of free cash flow from one site, and the market cap is currently 4.5 million. So basically, you're getting free cash flow of 50% of the current market cap every year just from the one site, and they've still got 2 more sites to come, and they're going to be adding on to those. So I've said it in the interview, and I've said when we were speaking to them, and I've said it. I'll say it now. It's worth several factors more than it is now. Several factors. It came to the market at 12.5p. And it's now 2.5p. It's like, what else is there to say? And the country needs it. As he said, there's going to be a 400% increase in the requirement for this. There's 1 terawatts and they need 4 within the next 5 to 8 years, I think it was, he said. So, it's got to happen. Otherwise, the whole grid isn't going to work properly. That's
good.
It.
Well, moving on to the week that was, and obviously looking forward ahead, we're joined today by an old friend. Who might that be? Does anyone make any guesses? Listen, you probably know within about 3 seconds of, or probably even less than that, 1 second of hearing his voice. Do you want to say hello?
Hello. How are you doing?
Oh, he's back, his lad. How's it going?
The original roast. Back.
Not too bad. It must be a year since I've been on there chatting to you guys. Must be about a year.
And how's things going? How's your life in general? I mean, you've been a busy bloke. You were always busy. It was always quite difficult to pin you down and get you not necessarily get you on the show, because obviously you gave up a lot of time, but you're always very busy, jetting off here, jetting off there, working.
Well, the lockdowns and so on. Now the COVID's cleared away.
Yeah,
finally, I think a lot of people have had a big year this year. I've been to Ibiza 3 times, been to Miami. I've spent a lot of money, burnt a lot of money out there, but it was worth it. You can't take it with you, can you?
No, exactly.
You get those memories when you're laying there on your deathbed.
How's it been on the markets? Have you been? You're obviously quite a bit of a swing trader, and you got your bot going on and things. And how's
I've tried with the bear market at the minute. It's very bad. I think it's about 75% bear market if you do the 200-day moving average comparisons. But I've tried all sorts since we last spoke. I was long-term investing, but I mean, in this market, if you're holding, it's just with the hikes, interest rate hikes, and until inflation starts pulling back a little bit and the hikes stop, the long holding is painful. So I actually closed everything I was holding. Plus, we transitioned out of COVID. I was trading some of the COVID stuff, trying to get multi-baggers out of the SCLP and the vaccines, and I think. Like this time last year, I think SNG just popped its phase 3 trials. Luckily, I'd pulled out a huge position from there just before it put some on the bench because COVID was kind of clearing up and variants didn't seem to having as much impact, and the testing was still there, but there was more testers, and it was a bit flooded, starting to get flooded. So closed out of that, and then the war came. So the war came, and I didn't really like, you didn't know what to touch. I had cash on the bench there. I started getting into the EMAs and the targets. Then I moved into, I was closing my positions at the end of every day because it's so hard to predict the market when there's a war going on. There's things I wish I'd bought that I didn't buy. And then I started kind of day trading. I started going into the approach where I'd look at news coming in the morning and I'd coded up something to tell me for each stock I wanted to know, because I noticed that the market makers started gapping things to EMAs. So if you can see that good news is coming on this stock and it's got a small cap and float, or or something, and it's got a big EMA target, then generally this is where you start building an algorithm. What sector's it in? What's the EMA target? What's the size of the market cap? You go back, you look at, what's the placing price? Because if it comes and it's going to go to that EMA and the placing was at 5p and the EMA's at 6, what's going to happen? Everyone that wants to get out is going to sell. So all of this stuff, started structuring it and building like that. It was working quite well, actually. I wrote a page called Big Papa, and that was one of the algos. So I've got a Mooner's algorithm, a Big Papa algorithm. Big Papa is a Big Papa. It's named after someone I know from Ibiza, an old guy. He's a legend, smoked cigars. And what the Big Papa was, it'd be a stock with a big target. And it'd tell me, it would say, right, this has got news, it's got a big target. And it'd just flag them to look at. So I went into that. And then after the trading period, where I was kind of looking at the news that comes in the morning, and I think after the first hike, things started changing a little bit. And the news wasn't moving the market as good. Things were pulling back, the rate hikes, the EMAs were big. A lot of people were closing a lot of positions, because with rate hikes, what you get is you get people pulling out. If you've got a good bank, the interest rates are going up. If you've got the money, people take it off, put it in the bank, safeguard it, or have cash on the bench to trade with, or do both. Yeah. So when each hike, it's bad for you personally, unless you've got money in a good bank, because when the rates go up, if your money's in the bank, you're going to make interest on it rather than try and play the minefield of the market when it's bare.
Also, the fact is, if you've got money in the bank and you've got high inflation, your pounds, it's the worst place for it in reality, isn't it?
Well, it depends what you're doing. I mean, some of the banks, they do offer good rates, and if but yeah, that is true. It just depends how you live as well, doesn't it, with the inflation? So hopefully, the unemployment will probably go up, inflation will, the hikes will continue, but then hopefully the inflation will pull back a little bit, and we might get a flip round on the market, but it's going to take a while for that to happen. But also, it's coming to October now, so Wall Street, the market's about to get back to work. We've just gone through the summer holidays, which is a bleak period. You're trying to trade that. There's not a lot of volume in the markets, but especially with the hikes, a lot of the long holders have been trimming and pulling positions. But now that there is a lot of cash on the bench, just like this time every year. So kids went back to school this week. I'm expecting the market, the volume to pick up. And what I'm currently doing at the moment is, so I had the EMAs. So EMAs, if people don't know what they're used for, because a lot of people that invest, I used to be one that did invest, and what's a chart do? The thing is, what a chart does is, if 70% or the funds, everyone use EMAs, RSIs, and if you've got these little technicals behind you, where people are going to sell the stock and buy the stock. So you can use like the stop, the RSI, the MACD crossover to figure out, is it an upward trend or a downward trend? And then, I mean, you could get great news, but it might be on a downward trend. It might have a place in the background where the price is where. So what happened was I coded that I started looking at EMAs. It started with the gaps up on, when you get good news. And I was noticing that if you could get in before and then ride a gap, you were going to do well. So what I did was I looked at all of the market, and I looked at things coming out of COVID, and it was working really well. What was that? PHTM, or I found one. I started going backwards rather than reading the RNS in the morning. I started finding stuff where the results was due. So I made a results calendar, and for every day I knew what news was coming. And at the end of every day, I'd write down, and I'd write good, outstanding, or okay. And I'd know what date the results were coming in. PHTM was a corker, because I was looking, things had come out of COVID. But if you look at their previous results, so what you do is you look at the results, then you look at the prior update, and that prior update is going to give you an indicator. So if you've got, if you're doing a year-on-year comparison, which you generally do year-on-year, interims or final, whatever, what you'll see is that year-on-year comparison where you get a big percentage there, the MMs might gap it. So PHTM, what do? They take passport photos. I've been flying everywhere. So I was like, well, this is just smacking me in the face. I need to buy it. Told a few people about PHTM, year-on-year revenue, 100%, whatever it was. It was only 20-30%, and it was a trade, because in this market, there's a lot of sell-on news. But if you can do 20% on a couple of trades a week and you go big, you're going to do well. But then as the hikes continue, and we're going into a different world, there's so many dynamics, the war, the hikes. There's some things coming out of COVID, some things you'd think are good to invest are being pulled back by the hikes, because it's a catch-22. You're trying to forecast, right? RTM is great. RTM is the restaurant group, Wagamamas and all sorts. They've not been busy for the last year, so year-on-year results are going to be good. What's the outlook look like? If there's all these hikes and heating bills, and you've got a restaurant group, well, right now the year-on-years are going to look good, but in 6 months they're not going to look good, or a year's time they're not going to look good, because they're going to go down. And this is what investors are trying to figure out. So it's very tricky trying to plug investments at the minute. I'm sure right now, if you look at a 5-year vision, you'll be fine. But I don't like leaving my cash static for 5 years. So I feel like I could do more with it in between, and then have more to invest at the right time.
So if you had a message, or there's one message you could take home that you've learned in the last, say, 12 months or 18 months since we had the COVID casino days, how has your investment strategy changed? You used to be, wind back to the start of the ropes. You were very much a staunch hold man. You believe in the story. And then you now become this. You've got your great bot, and that. So to just tell people why you change.
Well, yeah. I think if you want to work the markets all the time, you can't be the same person. You need to be dynamic.
Yeah.
You can't be the same person on the market. You're going to get toasted. Unless you're Warren Buffett and you're just going to hold it for 60 years, or the market changes every week.
You have to be like Jekyll and Hyde, So
but what's going on with them? I mean, with the markets right now, the war, the hikes, the COVID coming out, there's so much going on. It's trying to know, even trying to, like when I'm trying to forward think on some of these stocks, well, all of a sudden it's a terrible idea. So I gave up on the results calendar. And then I went back to trading.
Oh, but the resource sector has got to have its day in the next period of time, because it's been so beaten down, especially in the small.
Yeah, well, I mean, because the problem is with the current bear market. I mean, generally coming out of a recession, going into a recession, people invest in gold, don't they? Because, like you say, the money in the bank over a longer period of time. But the problem is at the minute is you've got so many dynamics on. People just think, is it the bottom? Resources is definitely going to get hammered at some point. It's going to get hammered. But I mean, in this country and on the LSE, the whole country with the resources, we need to localize something. It's proven with the war in Russia. Look what's happened to the prices of gas, and Putin's sitting there with his big, switch. You can just turn it off. How do you know what's a good idea? So,
well, interesting thing is you've got two parts of the resource play. You've got the big players who have basically been milking a lot of money in the last while for the good prices that are about, even though they've dropped a bit. And then you've got the small cap miners who aren't yet miners, maybe more explorers, and they've got the assets that the big boys need. So I think there's going to be a lot of M&A in 2023. This was something Colin Bird said to us this week as well. But I can see it. There's going to be a lot of M&A activity, and that's going to allow a lot of these small guys to have their assets properly valued again, because they're not valued properly at the minute. They're ridiculously.
I think it's knowing where's the bottom. What's the trends? Where's the bottom? It's like, I mean, I don't really touch oil and gas, but when that fracking stuff came out, it was the most exciting things that had happened for a while. So I went in on the old iGas, and I was looking. So now, what was Phil's question was the difference is now what I would have, what I've learned, or what, I think understanding the technicals is really good in this market, because if you understand the technicals, you can pull your positions. You can still buy what you want as holds, but you don't need to watch your cash go down. Also, with the news in the morning, you can get cracking news, FDA approval. I mean, I got the FDA approval. The bot sent it me for Angel, was it? We've been waiting for that for a while. The bot sent it me, I was in. But you knew as soon as it gets to that 200 EMA, it's going to pop. And it got to the 200 EMA. I sold it at the 200 EMA. It popped. It went straight back down to its lows, because a lot of people were in that as a trade, an FDA trade. Everyone knows FDA trades are good. The price had pulled back. People were waiting for it. Got the volume. Now look at it. It's, people now people have got to wait. So if you understand the targets and don't get blinded by that, the golden carrot. I mean, I've done that. If you know it's an FDA stock, it's going to come FDA news. Then if you know where these moving averages are, then you're probably going to get a better deal than there's probably people in AGL and they'll hate me because they'll think I'm a trader, because I used to hate traders. But the thing is, if you want to make money, you could hold AGL now for 2 years, and it probably won't go back to that price. It might not, go to that price unless something substantial happens. And it's so where I've changed is I'm using moving averages and technicals with the help of some of my friends. They do it manually on the charts, but I've coded it all, so it just tells me straight away. The one thing I got to was, well, what if it goes above the 200 EMA? Well, I look at the 400 EMA. Well, what if the 400 EMA is less than the 200 EMA? Where do I go? So that's where you use what's called Fibonacci, so the Fibonacci sequencing. And you've got uptrend, downtrend. It kind of tells you where to buy, where to sell. So you've got retraces and extensions. Extensions are where you sell, retraces are where you buy. Now, in this market, from what I've seen with Fibonacci's, say if news came in, like iGas, I would have never have touched iGas because it was above the 200 EMA. Now, and the RSI is overbought, the stock's overbought, crossed the MACD ages ago, which it's on an uptrend, but it's blown its averages away and it's overbought. Now, to buy that, you'd think, Jesus, man, I don't want to buy this. This is risky. Now, what you do is if you code in the Fibonacci, it's going to show you the Fibonacci sequence up, which is the high minus the low times by a fib percentage. Now, it might not mean a lot, but the thing is this is what a lot of the market use. They use the fibs. So an example would be, I've bought iGas. I'd have never have touched it in the past, but I've bought it. It's gone up since I bought it. So I looked at the fibs. Now, what you do is you buy, and it looks like it's on a spike, it's overbought. I think iGas is going to do really well. But where the fibs come in is I'm monitoring it. So if it doesn't get resistance on the fibs, I don't sell it. If it starts getting resistance on the fibs, I can probably sell it on the uptrend extension of the fib.
So for the skeptic in me, again, I'm no chartist, but obviously I love hearing your the way you talk about it and the kind of learning more. But obviously there was an RNS that came out on the Thursday that said, obviously, response to government statement, RE the shale moratorium. Obviously, this is in response to Liz Truss's removing the moratorium on hydraulic fracking in England. So obviously that is a big boom, because there's a lot of these companies in the UK that obviously rely heavily on fracking. So that's obviously given an uplift of about 12.5-13% just in that single day. So
it was up before, because a lot of people knew it was coming already. Yeah, but the thing is if you're sitting on a big gas resource and it's going to go local, it isn't just, wow, this is a good trade. It's actually, is this going to do an NCY?
So if that news came out, but the charts didn't look right, you wouldn't have bought. So it was.
I bought it before the news.
Okay.
Yeah. So what I mean, there's different ways you can do it. One is to go off the news, but if you already know some of the things you do, sentiment and sector. What's the sentiment? What's the sector? Then you go to then you could have a look at a chart. Chartists don't even look at news sometimes. They'll just go, right, it's fallen back to a Fibonacci retrace, and they'll just buy at the Fibonacci retrace, because a lot of others will. And then what they'll do is they'll sell at the Fibonacci extension, and they'll probably get turbulence going through the EMAs. So you'd be looking for, is it oversold? Yeah, it's oversold. If you want to buy a news stock, you'd be looking at the EMA targets, pending FDA or some news is going to come, and it's oversold. Now, you'd buy that and you just sit there and wait. I've done that on IDE, because IDE EBIT's going to go up, and the results are delayed, but they're coming this month. So, I've also coded something that tells me what stocks the MM's gap. So I know every stock on the market, and I've even got a gap percentage. IDE gets gapped by the MMs. I bought that. It's oversold. It's sitting flat, actually. I think it was oversold a while ago, but it's sitting flat. That, I don't know what's going to happen. They're going to RTO, they're going to, So that's one. But I mean, with iGas, that one is just sentiment sector. I don't care about the news. It is, look at the future prospects. Now you go in, it's overbought. It's off the 200-day. It's over the 200, 400, 800-day moving averages. It's sky high. It's 600% up. You think, whoa, I can't buy this. But really look at the Fibonacci's and think about the sector it's in. And then if you buy in, which way is it going? It's still uptrend. The market's uptrend. It's going to get to the next fib. It's going to get through it. Is it going to get through it? I mean, there's all harmonics and, real technical patterns people use. But one of the things is, what I've learned is, if you buy a stock and you look at it and you think, I love this company. Generally, if you're buying a stock, you want to make money. No matter what anyone says, you're not buying the stock because you love the CEO. Well, you might be buying the stock because you think the CEO is good, but you're putting money in it because you want to make money. Anyone who buys a stock wants to make money. Else, why would you buy the stock? I want to make money, so set a target. If you hit the target, sell it. Or if you hit the target, sell half. And if you really like the company, just let some run long, even if the company goes to the ground. But when you buy a stock, you don't want to lose money. So that concept is, don't fall in love with a company. And Phil says, what have you learned? What I've learned is, I buy stocks because I want to make money. For sure. If the CEO's nice, it's a bonus, if they're doing something great to the world, it's a bonus. But it's binary, black and white. I'm buying something because I want to make money. I'll buy something next week that I wouldn't have bought last week, because the markets are moving targets, so the sentiment's going to change. And the problem is if you're taking placings in stocks as well, the problem is what's a good idea at the time you take the placing might be a terrible idea in a week. That's the kind of market we're in. This is why people are finding it hard to raise at the moment. I've had brokers calling me.
Nobody wanted to buy Mast last week, but today people started to buy it, and I expect that people will continue to buy it because it's in electricity.
Exactly. If you've got that sentiment, that's one of the key things at the minute. If you've got an angle with a sector and a sentiment, you're gonna find it easy. If you've got a question mark in that sector, you're gonna find it hard to raise at the minute.
Yeah. Listen, guys.
And if you do raise, you're gonna be raising cheap.
Sure.
You're gonna dilute the hell. So
it's all fascinating stuff, and we could probably talk for hours. And you know, Albert, you and I have talked for hours in the past on it, you know, until the wee hours. But if you could pick a stock, I mean, you obviously mentioned iGas. Is there anything else that's on your radar at the moment that you want to mention?
There's something I absolutely love right now. This company, I got some aggression because, sometimes people, the companies the cash is looking minimal, you know. Now, I really like this one. It's called SWG. Now, what they've got is, prior to COVID, there was a lot of terrorism, but it kind of got hidden behind COVID and put on a back burner. There was the Manchester bomb, it's awful. Westminster Group. Now, if you have a look, there's a new legislation coming in, yeah? So if you have a look at WSG, and I'll explain the financials as well. There was a TR1 selling it today, but I don't care about that. I really like this. So there's a legislation coming in called Protect Duty, right? A lot of people bought this at 10p. It's pulled back. I think the cap's about 8 or 9 million, something like that. Fag packet calc. But what they've got, right? So there's a legislation coming in. They've won, and I saw the contract when it came in. They've won a contract with a cinema, right? That contract with a cinema it's to do. They can do 7k an hour, and they mass screen people 7k an hour with their cybersecurity or their technical devices. 7k an hour. This is a legislation. This is going to be enforced. How do you sell something to everyone in the country? Via legislation. Oh, I used to want to sell smart meters and get that legislation put there for that, so everyone would have to buy a smart meter off me. You're not going to be able to go to an event. People have come out of COVID. People are going to events, football matches, everything. You're going to have one of these tests. It's not a test, it's a check. The cap is about 9 million, but they've got a contract with a cinema and they're doing a pilot test in a European airport. For me, that is a sentiment hitter. Right now in this bear market, not a lot of people might, you might not think, whoa, that's interesting. But for me, especially coming through the COVID and the testing, and they've got some of the first contracts out there and the legislation's coming. Now, the only thing about this stock that someone tried to give me some stick for was, and I already knew the financials, they placed a couple of mil about a year ago. They've got about 400k left. However, I looked at the placing. Well, in the placing last time, which was at about 5.8p, I think, the stock price was only 8% above that. If there were 40% discount, I'd be worried. But it was like when we were in MHC and they placed, the stock went up because the sentiment was there and they were selling test kits to people that were flying when COVID was around. It's the sentiment. When they've got the fund, that's it. That's out of the way. I think they've got about 3 months funding left. They've got about 400k. But for me, this one is also the warrants were at 7p. So there was a warrant incentive, and I think they've got 12 months left on those. So at the point where they do raise, I think they'll get a few more contracts out there before they do, because they'll want the price up. They don't want to raise this like.
They've had all sorts of international contracts for the anti-terrorism in the airports and different things all over the world. Yeah.
I think this is really good. I think they've got the fingers in some early stage pies. I see this as is it NYCT, NCYT? I always get it the wrong way around. But I remember when Noversight was 7p. And I think I was in at 70p at one point. And then, I think I sold out. I got popped off on a stop loss. I think I bought it at 79p, sold it at 72p. Then it went to 12 quid.
Phil, tell me, what's your pick for the next couple of weeks?
There's a couple, actually. Well, the first one has moved pretty well. So let's just say it remains a hold. That's Prospects Energy. You've probably seen we've interviewed Mark Routh, the CEO, been on the show before. That's looking very good actually. It's risen from about the 5p to the 7.5 pence mark. I think it sits around 7p at the moment. They've got
Italian gas, which is the theme again we're talking about.
Exactly. It's Italy and it's Spain, so it's a relatively it's a safe jurisdiction. It's not like in Outer Mongolia or in the DR Congo or somewhere like that. So it's it's close to us, and they've already got revenues coming in from the Spanish asset, but the Selva field in Italy is going to be first gas in sort of end of Q1 2023. So that's looking very good, and a very small cap. The EBIT is going to be in the multiple millions per month, so it's looking like a really low cap. It's almost another iGas when I look at it in terms of they're going to be producing vast amounts of gas. So looks excellent, that one. That's PXEN. And the other one, which is sat under the radar for months and months, the company called Great Southern Copper, and it's GSCU is the ticker. And they came to market in December 21, and they raised 3.5 million at IPO on the LSE. They're a Chile-focused exploration company, and they're targeting large-scale copper and gold deposit. And the thing about them is they've got a very experienced board. The guy Sam, who's the CEO, was involved heavily in Greatland Gold about 5 to 10 years ago. So he kind of built the company along with Gervais Heddle. So he's got a sort of track record of adding value to companies. They are positioned in Chile, which is, as you probably know, is the biggest producer of an exporter of copper in the world. And they're sat pretty close to Newcrest. Newcrest have got a lot of assets there. It's a porphyry style system on a coastal belt, and you can see if you look on the maps that they've got very they've got assets near them which are already producing. They're in a relatively underexplored region relative to the Andean belt, but it certainly looks like at a cap of, I don't know, around the sort of 6-7 million. It's looking like a good play when you look at the peer company valuations. So for me, it's I think it came to market at about the 5p mark, as I say, in December 21, and it dropped to 2.5 pence, which seemed to be the bottom. And now it's risen. I think the last trading day it finished around the 3.5 pence mark. So there has been a bit of a rise recently. They're waiting on some assay results from one of the assets, which has been obviously drilled. And good luck to them. Let's see what they come back with from the assay results. And it certainly looks pretty exciting.
Sounds interesting. Well, I'm going to join you then if we're all doing some picks for the next few weeks, literally. There is going to be some results from Star Resources, Kazakhstan Explorer. It's got 3 gold targets that's identified. One that already has an out-of-date JORC of nearly a million ounces, or 900 and something thousand ounces. They've got some massive copper plays as well, and also a rare earth, which has basically expanded tenfold in the last couple of weeks. There was another RNS expanding it. And basically China's got the rare earth stuff wrapped up, especially for the magnets that are required for the batteries. And this type of stuff is literally a shovel-ready, dig-it-up rare earth, which will go into the EV batteries. So for me, that's the real player. I mean, literally, if the volume involved with Star Resources is really there in the rare earth, it could be worth like hundreds of millions, if not billions. So for me, there's going to be gold results within September, and that should hopefully kickstart it. It's got a market cap of about £9 million, and I just got a long way to go. I see Greatland Gold only even bigger in this company, to be honest with you. And Alex, the guy who runs it, Alex Walker, very switched on guy, ex-army guy who is very particular about what he's doing. It's like sweets in a candy shop, I think, for him, because there's many majors out there, but basically the government owns 20% of every asset that they own, and they own 80% of it. So there shouldn't be problems with the government. There shouldn't be problems with them getting licenses. It should all be very nice, So that would be my first one. My second one is definitely what we've just interviewed, Mast Energy Developments. As far as I'm concerned, it's massively undervalued. It's in the right sector at the minute. It's electricity. as you will have already listened, they're basically making 4 times the cash flow profit that they expected to when they first took over this site. And to be making £2.4 million a year from one site with a market cap of 4.5 million, it just doesn't make any sense. So they're my 2 plays. And I hope over the next month, 6 weeks, then, I wouldn't be surprised if both of them doubled. That would be my hope.
I think there's been some great suggestions there. It's really refreshing to have you back on as a guest, Albert. It was really great to have you on, as I say, and really look forward to hearing how how the things are going with your bot and everything. Obviously, the other thing is it's going to be very interesting times in the next sort of week, as what potentially national life could be put on hold. Obviously, television schedules will change, and organisations or charities will organise ways of paying respects. There will then obviously be the state funeral of the Queen, which could take place in the next 2 weeks. And I guess obviously doesn't mean that there'll be a complete shutdown, but public transport will remain same. But even if business carries on, it's unlikely to be business as usual. So on that note, thanks very much, guys, and we'll speak to you soon.
Cheers, everybody.
Yeah, thanks for coming, Albert. It's really good listening to you again.
Cheers, guys.
This podcast was brought to you by Roast PR Limited. If you would like to appear on a future episode of The Sunday Roast, please email admin@thesundayroast.net.